Welcome, everyone. It's great to be here today. I'm Dave Stoffaker, the Senior Credit Trainer with Lenders Online Training. Now, to our regular followers, you may notice that my colleague, Linda Keith, our Chief Credit Trainer, she's not here this week. She's actually enjoying some family time on vacation, so good for her. Today, I'm actually going to dive into a topic that kind of can be complex at times. It's the relationship between balance sheets and the stories that they tell. We're all familiar with balance sheets as being one of the key financial statements, but what role do they have in the loan process? We know the basics: assets, liabilities, equity. But the thing is, balance sheets are not that snapshot in time of the current financial health of a company. They actually can provide some valuable insights as to the future trajectory of any type of company. Today is the first of two-part series of the balance sheet. We're going to focus on the potential risks of the balance sheet. Think of them as red flags. We've talked about that concept in the past. Those are potential signals of maybe some risk concerns that might be forthcoming. In a future live stream, I'm actually going to talk on the flip side: green lights, opportunities, hidden opportunities that we might uncover in a balance sheet that might lead to some creative financial opportunities that we can actually help our borrower. So let's actually get started. The first one I want to talk about is dropping liquidity, or as I like to think of it, as a cash flow mismatch. And we've all heard the cliche, cash is king. But how do we spot when the cash is actually slipping away and maybe the business's liquidity is actually experiencing bigger problems down the road? A business might at first glance be relatively stable, healthy income, reasonable debt. Maybe it's actually a decent looking balance sheet. But the liquidity issues can actually sneak up on us if we're not aware of that. It's kind of that mismatch between short-term obligations and the cash coming into the company. Here's an example. I'd worked with a construction company some time ago, and their balance sheet was pretty stable. Right? They had some steady revenue. They had a solid balance sheet. They had a decent amount of equipment holdings and manageable debt. But when I really looked at it closer, what I started to notice is the payables were actually exceeding the receivables. Deferred revenues were actually starting to increase. Cash was a little bit light and actually declining slowly over years. They had a lot of credit. That line of credit was in use and likely to be evergreen. So this was probably leading me to believe, or implying the fact that the borrower was actually using short-term monies to help out with that operational gap, right? They were struggling for cash. So despite looking fine on paper, when you kind of do an overview, there was actually a liquidity problem actually brewing. So this mismatch between what I would say money coming in, money going out, was actually creating some operational inefficiencies. Actually, it was increasing debt. Both of those was starting to eat into cash, definitely eating into profitability. Fortunately, I worked with a supportive banker at the time, and we sat down with the bar. We did a little bit of restructuring, a little bit of discipline planning to make sure that we were on the right course, and the company turned things around. And thankfully for the banker, and maybe some potential risk was actually avoided, and it was able to be a win-win. So what's the takeaway? I think if you spot liquidity issues, I think the early warning signs can actually lead to more significant problems down the road. The faster we act, we address those, I think the better off we're going to be. Let's move on to another one. Aging assets, asset quality, specifically aging equipment assets. I mean, focusing on asset quality is specifically equipment, as we mentioned before, is physical assets that are on your balance sheet. The values can be a little bit misleading. When you look at the balance sheet, depreciation methods, they're chosen for tax purposes, often can distort it a little bit. Market values can definitely differ than what we have on the historical cost. I mean, the equipment could be fully depreciated, or it could have been accelerated through depreciation to reduce it for tax purposes. So quite honestly, understanding if it was the former, that the assets were fully depreciated or towards the end of their useful life, and really what is useful life? It is somewhat subjective. The question leads to believe is if they are obsolete, maybe the equipment is probably inefficient, leading to higher repair costs. Production cycles are probably going to be longer. And what's that going to lead to? Probably lower profits. The cash flow impact probably in the future is going to be more of a problem. The takeaway here, what we're able to do is looking at the balance sheet, if you can ask yourself the question is really what is the actual residual value of these assets? If it's fully depreciation, the book value doesn't look very good, but maybe there is some hidden value there. If so, maybe there's an appraisal that might be needed. If we get an appraisal, we see some equipment that has some value there, or maybe we do some creative structuring or off balance sheet structuring, and we might be able to upgrade and improve the equipment, hopefully to turn the company around rather than continually going down on a downward spend. Number 3, I like this one. This is the mismatch between current liabilities and current debt. This is the other side of the balance sheet, right? We talk about the correlation between short-term liabilities, long-term debt. That imbalance could itself cause some problems. I mean, it can happen when a business has a high proportion of short-term liabilities in comparison to short-term assets. Honestly, it could happen when you have a lot of fixed assets that have been funded by short-term assets or short-term liabilities. I worked with a company that was an equipment dealer. They had about $700,000 in short-term debt. Now, they used that primarily as a floor plan line of credit. Now, the equipment was primarily used for rental streams. They sold some pieces of equipment, but oftentimes they would actually use that equipment and rent it out. So there was a longer-term payback on that. But it was financed through a short-term facility. Well, it didn't match up. The impact with long-term assets that had a longer useful life, but the streams of revenue coming in was extended, wasn't matching up with the required payments that the bank or the funding facility wanted to do. That mismatch caused greater problems with their cash flow. Now, what could have happened? Well, maybe if you would have matched this up to a longer-term facility, maybe an intermediate-term loan, maybe that would have matched to the revenue streams. If it was truly going to be fixed assets or an inventory that's actually going to be generating longer revenue streams, that makes sense. If it was a traditional floor plan where product is there, it's there for a short term, it's sold off the lot and we replenish it, well, maybe a line of credit might have been fine. Here it didn't match. Problem was it does create some strain for that client. We worked with the banker, we repositioned a couple of things, and it was able to kind of match up the revenue streams, the majority of revenue streams, to what they had to make their payment. But just look in the balance sheet, things that might have been started. Let's go on to the last one. This happens to do with the retained earnings section. Declining trends kind of leads to a variety of items, maybe shrinking margins. For example, I actually have 2 examples I want to talk about. If we see a company where the revenue streams kind of continually grow, but their return earnings are kind of just lay flat, not really moving around, it might be a red flag. Example number 1, worked with a large food wholesaler, and their revenues were growing, slowly, but they were increasing. They were doing fine. But it wasn't generating the profits, or in this case, it wasn't transferred over to the retained earnings. The retained earnings was staying flat. So what was going on? Well, as we got a little bit into it, we basically realized that their margins were shrinking. Inflation, some supply chain issues were impacting that, but they weren't adjusting their prices. Although the product was generating sales, it wasn't covering their costs, and that money wasn't transferred over to retained earnings. Now, truth be told, this company had been around for a while, and it was also some owners had been involved with the company for a long, long time, and they were starting to take a little more money out of the company, which that too was impacting the retained earnings. So while the company was rising in sales, margins were shrinking, the owners were taking a little extra money out there. So it was a matter of just having the conversations, learning a little bit more from that but we wouldn't have had those conversations had we not talked a little bit further in the evaluation of the retained earnings. Here's another example. This comes up a lot more when you're dealing with fixed assets, maybe real estate. Real estate or those type of assets are sitting on your balance sheet at a historic cost. In most cases, real estate rises. So if I have a property that's on the books for, a set period of time or $500,000 and it grows over time, we have market value increases. An appraiser will often tell us that property is higher, of which then we may lend on it if the loan to value ratio works out. Now that money may be used for a variety of purposes, but the balance sheet isn't going to change. It may have a new debt because we've lent more money on it, but where's the money going? So that can happen at times where all of a sudden our retained earnings is going the other way because we're lending against it. We're basically adding more debt to the company, but our asset values aren't increasing. And if the owners take that money out, which happens on occasion if they're going to invest in another property, it could cause your retained earnings to slip downward. A key issue to say, hey, we might have a red flag there. So declining retained earnings is often critical for us to analyze. It's kind of a key indicator. What's happening in that residual of what's going on with the company? So let's wrap this up, connect the dots basically. Think about balance sheets as kind of a potent tool, not just understanding where that company's financial health is at a specific day and time. Actually, it's a tool to understand where it is possibly going. It's not just about the numbers. It's actually the stories behind the numbers that I really like. Actually, in our training sessions, even today, we talked and recommended our lenders to always look beyond the surface. Look behind the numbers. I always like to say that. Look for concerns, maybe red flags that might have popping up for a little bit. Or we'll find out in a few weeks, maybe there's some opportunities that we actually can lend some more money. So now you have it. Part 1 of the balance sheet series. 5 examples of red flags that could come up once you look beyond the numbers, so to speak. Don't forget, coming forward, we're going to have part 2 of the balance sheets where I'm going to flip the story a little bit. I want to talk about the green lights, opportunities that maybe we can actually lend some money or help our borrowers an opportunity for additional capital so they can be successful in the future. What I want to do is let you know that if you have any junior lenders, maybe some credit analysts that are coming on board, consider sending them to Lenders Online Training. Our program is designed for not only income tax analysis, it's also for financial statement analysis. We help them understand kind of key complex issues. We want to develop their skill set for them to be better lenders as they go forward. I want to thank you all today for stopping by and listening to this live stream. I asked my producer to actually put on our website there, Experts on Online Training. Feel free to reach out with an email, ask us some questions. It's those questions that we often kind of have some discussions on our live stream, or we're also available for any other questions that may come up. With that, I want to sign off. Thank you very much for today. I wish you a wonderful week and see you in a couple weeks.